Hey folks, and happy Monday to you. I got a little dilemma to ask you guys. Do you want my channel? Do you like my channel talking about the economics of things? Or would you prefer if I really talk more about mortgages? Because I'm a mortgage advisor. I've done it for over 30 years, and my goal here is to educate and inform you guys when you decide to buy that first house or maybe that first investment property. How do you do it? So I'm not out there pumping FOMO. So if you're out there and you're like, hey, Dan, you're pushing everybody to buy houses, I want to disclaim one thing to you real quick. I don't care if you buy a house. My goal is once you decide to, for you and your family, please reach out to us. We'd like to give you all the options and our 30 years of experience in this field to help you maneuver through this minefield when you're looking to buy your first house. That's all. I'm not FOMOing it. I'm not doing anything else. I want you to be an informed consumer before you kind of take that leap of faith buying your first house. So in today's video, we're going to talk about a few things. We're going to talk about the Fed. We're going to talk about those jobs numbers that came out last week that really played havoc in the market. So let's recap what happened last week. Well, a couple weeks ago, we went from the banking disaster that was going to collapse the whole country and the world. That went away pretty quick. And then the next thing we had was the debt ceiling. Oh my goodness, the debt ceiling was going to take place. And if that didn't go through, nobody would get their checks. The whole country would default on their debt, and it would be a worldwide catastrophic event. Well, now that's past us. So Saudi Arabia is now cutting oil production once again. So what we're expecting from this, and this is why, guys, I watch oil prices because it is a big part of inflation. Just think about it. It takes a lot of money out of your pocket each month to get back and forth to work and back and forth to taking the kids there and just doing, your daily duties. How about diesel? Diesel. It gets the tractors to plow those fields, pick the fields, do this, transport the products from one place to another, transfer those products from Amazon to your front house. So diesel prices have gone down dramatically. Now Saudi Arabia is saying, well, we're going to cut production. What's going to happen? Well, gas prices are going to go up. What's going to happen then? Well, manufacturers and everybody are going to have to increase their prices. Again, AKA inflation, going to have to continue to increase their prices to offset this, or they're going to have lower profit margins. So our government really has to step in and make a cure of this. Do me one favor. Go back and watch a presidential debate from, just pick out the 70s. Just say the 70s. I don't care who you watch. Watch the topics that they talk about. It's inflation, immigration, the Middle East, and oil. So do they really want to solve this problem? If they really did, do you think they'd be able to fix it over the last 50, 60, 70 years? That's a question for another time. So let's get over to some of the things that I'm worried about. It's oil. And the big thing is why? Well, here's what oil's been doing. If you go through here and look over the last 5 years, want to see what oil prices have been doing. If you go down through here, look at this. It peaked out when? June 3rd of 2022 at $118 a barrel. Where are we today? Well, $72. So we're substantially lower than where we were. But look at this also. If you go back through here, June of 2022, what was another piece of the equation of this whole economy back in 2022? Well, it was the top of the inflation number. The highest inflation number we had in readings was June of 2022. Is this an anomaly that its oil prices were that high at that time, peaked out, or is it just something else? That's for you guys to try to figure out. That'll be my quiz for you guys for today. So that's that part of it. The next thing we want to talk about is the jobs numbers. So we know the jobs numbers came out on Friday, and the number was outstanding. But then that created some havoc in the markets because, again, let's recap what we saw on Friday. We saw a settlement of the debt ceiling. So my thought on the debt ceiling was, well, as soon as it got resolved, and I knew it would get resolved, we'd see about a 1,000 point swing in the Dow or in the stock market. We saw a little bit over half of that. And then I also predicted that the mortgage rates were going to drop about 0.5%. I missed it. How did I miss it? What went wrong? Well, the employment numbers came out, the jobs numbers came out, and they were crazy. There was expected to be about 180,000 new jobs created, and there was about 380 jobs created. So everybody's like, oh no, now what? The Federal Reserve's not going to pivot. But I want to show you an interesting article, and I'm going to put this article down below. This article basically goes through a lot of the jobs numbers. And what intrigued me on this is who's lying about the jobs numbers? So the piece I want you to take out of this, we don't have to read word by word, is let's go down through here and just look at charts, because pictures are better than 1,000 words. Here's the jobs numbers. So if you looked at this as a stock, the first thing I would be saying is, well, the trajectory is going down. It's staying in its parameters. So what is this telling us? Well, it's telling us the job market isn't really as robust as it might seem by some of these numbers. So let's go out and take this is a long-term look at the jobs numbers, but if you actually take this back, pull it way back, what's the jobs numbers actually look like? Well, here they are. Okay, so here they are. Over this time duration, if you take out all these wiggles and just straighten it out, where are the jobs? Well, right here. So this might basically paint a perfect picture of why I'm saying, even though the jobs numbers seem like they're robust, if you take out the COVID piece of this equation, we're only back to where we were in pre-pandemic. So we don't have that much or that robust of a job market out there. What's playing havoc on the market right now is people have too much money. That's represented in the M2 money supply. And I did a video last week, and I'll link that right up in this area here where you guys can check that out. The M2 money supply is 5 times higher than where we were in 2000. You guys might say, well, that's 20 years ago. I don't care how long ago. If there's 5 times the amount of money in circulation in people's bank accounts, that's going to create inflation, folks. Until that money is sucked out of the system, we're going to continually have inflation. And the Federal Reserve is doing their part in this. And then consumers are doing their part as well by buying and buying and buying. The one concern I have, guys, is stop using credit. Let's figure out what's going on with mortgage rates. What's the Federal Reserve going to do at the next meeting? Well, here's the probabilities of what they're going to do. So let's go to the top of this so I can explain to you guys what this is. So more and more YouTubers are starting to use this tool now that I've been using it. So that's interesting. So we're looking at the Chicago Mercantile Exchange to see what the futures market is telling us about what the Federal Reserve is going to do at the next meeting. So we have it right here. What is the likelihood that the Federal Reserve will change the federal targets rates at the FOMC meeting? The FOMC meeting is the Federal Reserve meeting, and it's going to take place on June 14th. So we go down through here, and here's the probabilities. Right now we're at 5 1/4, 5 to 5 1/4 right through here. Here's the meeting date right here on the left that we have. So we have the next meeting on June 14th and July 27th, and then it goes down all the way to November of 2024. So here's what the Federal Reserve controls. They control the federal funds rate right here. Okay, so right now that rate is set at 5 to 5 1/4. Well, last week the probability of it moving up another quarter to 5 1/4 to 5 1/2 went to almost 70%. Okay, now it's retracting back, and now you're starting to see it's back to 75% chance that the Federal Reserve won't do anything at next week's meeting. But now the probability in July or September is there's a 50% probability, or just a little bit higher than that they'll move rates then. So let's not look at this right now, because there's a ton of inflation data and employment data and everything coming in by then. So what this is saying is basically the Federal Reserve is not going to do anything next week. All right. So the next thing we want to see is, based on the data coming out today, which was really nothing, what's going on with mortgage rates? So to do that, we jump over to the bond market, and this is what I see on my screens on a daily basis. The good news is up in here, these numbers are green. You can't see them. Why? Well, I got a green screen behind me. So that's good news, because why? Here's what we follow on this channel. We follow what in the world mortgage rates are going to do. So over here, do we follow the 10-year treasury? Let me hear you guys. No. Why? Well, why should you? When there's a bond trading out there on Wall Street that actually yield is the biggest part of your mortgage rate. So we follow the MBS market. So right now we're seeing in the MBS market, let me get this out of here, a +9. It was just down 22. So something's shaking in the markets right now. I'll do my research and make sure to get back with you guys again tomorrow to give you the updates. But right now we saw the MBS market going from here all the way up to here. What did that mean? Well, this means is we're looking at the price of the bond. If the price of the bond goes up, which you're seeing right now because there's a +9, that means the price of the bond's going up. Is that good or bad for rates? Well, it's actually very good. When the price of a bond goes up, the yield goes down. All you have to do is know that there's a flip-flop effect. So when this number goes up, mortgage rates are getting better. When this number goes down, mortgage rates are getting worse. Where were rates? Where did they end last Friday? We're going to go over to Mortgage News Daily and check their website because they survey mortgage lenders all over the country to give us the data. So this data consists of, well, first you want to look at, these are the top 6 programs that people use when they're buying or refinancing a house. So what the criteria is behind this, I'm going to give it to you. Pay attention because you're looking at this and you're probably saying, well, that's not the rate I was quoted. Well, let me give you the information behind this. So to get these rates, here's what you would have to be doing. So you would have to have a 740 credit score or higher. You'd have to be buying your first home and be your primary house. It's got to be a single family house as well. You got to put 20% down. I said 20% down. Most programs, you don't need 20% down, especially if you're a first-time home buyer. You can get away with 3% down. But in this case, it's 20% down. So that's where these terms came from. So if you'd had all that criteria as of Friday on a national average, your rate would be 4.9%. Okay, but most likely your terms are a little bit different. Your scores may be higher, but you're putting less money down. Well, that's going to affect you. You might be buying a condo instead of a single family home, like a single family, just single built home. You might be buying a 2-unit building and not a single family home. So all these things will play a havoc when it comes to your mortgage rate. So how do you figure out what kind of rate would I qualify for? Well, let me show you. Just go over to therateupdate.com, and here we are. We're a mortgage advisor. I've been doing this for over 33 years. I have a staff of mortgage advisors waiting your call, waiting your application. How do you reach out to us to get some help? Well, the first thing is, if you're sitting there and you're like, hey, I got some questions for you. What do I need to do? Well, just call us, 844-775-5626. Or you're like, hey, I don't have any questions. I watch you guys all the time. I know what I'm doing. I need you guys' help because I love how you'll help me get pre-approved. You'll help vet realtors for me anywhere in the country that I'm looking for. And you're there at my beck and call basically 24/7 when I need you, even on weekends where my bank isn't there for me. Well, click over here, the Apply Now button. You're going to be set on your way. Or if you're like, hey, I just got some questions. You guys aren't available when I'm working. When I'm working, you're working. How can I do this? I have a consultation button down below. All you need to do is click that. You have a one-on-one consultation with me or one of my mortgage advisors to answer any questions that you got. So thank you so much for watching, guys. Please let me know. Do you want me to do more videos talking about mortgage programs? Or do you like my content talking about economics on a daily basis? So thanks again for watching. God bless, guys. And all I ask you to do is give us a thumbs up and subscribe down below. So every time I post a video, you get an alert. Take care, guys. God bless. I'll see you tomorrow. Bye-bye.